Good evening, everyone. Welcome to our conversation tonight on Mango Spaces. Now, we'll be refocusing attention tonight on Kenya's public debt, but just as important, the transparency around that public debt. As of 13th March, our living corner of East Africa has about 12.6 odd trillion shillings in public debt. If you want that in dollar terms, it's just over 97 billion US dollars, or around $1,800 for every single citizen in the Republic of Kenya. Now, we have a relatively clear idea of where this debt has been sourced from and how much we're paying back every single year. And the Kenyan government will insist, as they have in the past, that they're being reasonably transparent about what we owe and to whom that cash is owed. But the others will point out that's not the entire story. That's just a part of it. The Finance Ministry, for example, spent years in court saying it could not reveal the debt contracts between Kenya and the Exim Bank of China related to the SGR, citing national security. The courts disagreed with them and they lost that particular case. The Finance Minister most recently announced that debt had been reprofiled, but again, the terms of this new agreement have not been made public. And those are just two simple examples. So what are the real issues to deal with in transparency around Kenya's public debt? We'll explore that in detail with my panelists tonight. Bernard Njiri is a senior research analyst specializing in macro, fiscal, and debt analysis at the Institute of Public Finance. We have Stella Swake, who's an economic analyst, and Churchill Ogutu from IC Group, who's also joining us on this space for the next hour. So just a very brief overview. I want to start with you, Bernard. From where you stand in 30 seconds, what is the main problem, as you see it, with transparency on how much debt Kenya has and the terms on which we've borrowed it?
Thank you. I would like to pick it from a point that you have just said about non-disclosure of terms and conditions when it comes to borrowing. And that issue is not just with the Exim Bank of China in regard to the SGR loan. It also touches on other issues that are actually emerging, including the issue of securitization. Kenya publishes headline debt numbers, both for domestic and external borrowing, and this makes it difficult for citizens and even for parliamentarians to oversee debt if there is lack of full feasibility, especially on its pricing, the risks associated, as well as future obligations. And as we speak, there is a big concern around domestic debt. And I will come into details about this because domestic interest rates are high. They remain unsustainably high, making it so costly for the government. But the big question is, what is the incentive behind domestic borrowing? Is it because some of the banks are well connected to those who are in power? So those are some of the dynamics that I will go into details in this conversation. Thank you.
Same question to you, Stella. From your perspective, what's the big problem around debt transparency in the country today?
Thank you very much, Rama. And I want to agree with Bernard and you as well for the context that you've laid. And I'll just say that my biggest problem is the visibility that we have of the debt that Kenya has in general. So we have a lot of implementations and different innovations that have come in, especially in the last 1 or 2 years. And it has become problematic to actually follow up and track our debt because, as what Bernard has mentioned, in terms of securitization, that's one big conversation that we should all have. We have many other things that have come to be, including even what we did. I don't know whether I should call it debt, but what we did with the divestiture of Safaricom and foregoing dividends for a number of years and getting the money now. So there's a lot that lies within. And for me, it's not just about the size of our debt, the trillions that we keep counting, but the visibility that we have. Because from where I sit, we are managing debt, yes, but we are managing what we cannot necessarily tell is the true position of our debt. Because looking even at things like pending bills, again, that's another conundrum and another debt stock that Kenya has, of which we don't count it as debt, but still, from where I sit, I see this as debt. So for me, it's the visibility of what we are managing and not necessarily the size of what we have as the debt stock for Kenya.
Indeed. Churchill, you get the last round on this one. What is the main problem that you most commonly see with transparency around Kenya's public debt?
Thanks. Let me squeeze 3 points into 30 seconds. So the first is around the asset side of the debt. If you think about debt is a liability that the government eventually will have to pay, but the proceeds of the debt, where it's going to, I think that also cuts across in terms of transparency. We don't have visibility of where the debt is going, or what is being funded by the debt that you're incurring. Secondly, it's about publication of some of the debts, articles, say external debt register, or even the list of debt that has been incurred over the last 3 or 4 months. This is something that's normally done in Parliament, but you haven't seen that much. So it leads also to a lack of transparency. And then finally, I think there's some ambiguity in some sections of the law whereby it creates a room of transparency issues. So those 3 are key to me in terms of this discourse that we'll be having this evening.
And we'll get to most of them in the course of the hour. But I'll come back to you, Bernard, because I want to focus on fiscal consolidation. It's a term that we've heard for most of the last decade. And the simple explanation of fiscal consolidation is that we're essentially trying to reduce the amount of money that the government needs to borrow to the percentage of GDP in order to keep operations running. There are a couple of ways of doing that. Either you can raise revenue or you essentially cut spending. But every single time we hear from the finance ministry, we're going to cut our deficit, we're going to get on this trajectory, that'll take us down to around 3% of GDP. We've heard that repeated for most of the last decade, and the finance ministry has failed to hit it. Why is that?
It's a good question, but I would start by saying the issue is not lack of intent, because every year when you read the budget policy statement, the word fiscal consolidation will pop up. So government on paper will appear to have the intent to pursue fiscal consolidation. But that has not been the case. The government is not able to reduce the fiscal deficit sustainably because the said fiscal consolidation is just happening on paper, not structurally. On every financial year, if you look at the fiscal framework, we have structural mismatch between revenues and rigid expenditures. We start the financial year with projected revenues just to create a room for government to borrow. But in year, the government only revises revenue projections downwards, but expenditure projections are not revised downwards. And I want to now bring this closer home to see what that means now as we are nearing the end of the financial year 25-26. And right now, the conversation is about the financial year 26-27, and the proposed deficit as we speak is 1.1 trillion. How is that 1.1 trillion a concern as we speak? It's because revenue is already projected. And in this case, I'm referring to ordinary revenue. Why do I say so? In the financial year 24-25, the government was able to collect 2.4 trillion of ordinary revenue. But in 25-26, it projected to 2.7 trillion. So that growth is about 13%. And the reason the 2.7 trillion was inserted in the current financial year 25-26 is to give the government more room to even project further in 26-27, because right now the projection for ordinary revenue is 2.9 trillion. And the government is blind to the fact that we are nearing the electioneering year. Actually, in Kenya, we are feeling like we are in 2027. So that will create a shock to the revenue that the government is able to mobilize. Look at even what is happening outside of our borders. There will be effects to the level of economic activities because our demand for exports is affected by some of the conflicts happening outside our borders. But the government is not accepting that these are real issues and accept to set revenue projections to realistic economic experiences that we are in and the ones that we are likely to come up. So the problem here is the mismatch in our fiscal framework when you look at the revenue and the expenditure side.
I want to come back to the securitization question that was raised in the introductory part of the conversation. Jill, how should taxpayers assess the debts that we're taking on when we securitize a range of cash flows? We've done that with the Railway Development Levy. The law related to that was actually signed about 2 days ago. The road maintenance levy, that essentially has also been securitized in part, about 7 shillings a litre in total. Do we have enough safeguards in place to give us, as taxpayers, timely updates on all these debts and the underlying revenue streams are being used.
A quick glance of so far what you've done in terms of the securitization. We have the sports fund that has been securitized to be able to fund this stadium that is being built. So when you talk about the debt that is arising from this, we have a corporate bond that has been listed in the market. So it's listed, it's trading, probably not liquid as what we're seeing in the government securities, but it is already listed in the Nairobi Securities Exchange as far as the debt is concerned. So it's clear people can see the pricing as and when there's any trading activity that happens over there. But I think the question is now on the securitization and safeguards around that, or rather the underlying revenue, and that's on the sports fund. There's a whole bunch of things that we still don't know. There's an SPV, special purpose vehicle, and that has been created. There's some ring fencing of the revenue. In this case, now the sports fund levies are being ring fenced, and then the special purpose vehicle having the fast charge on this revenue. But the safeguard that needs to be done, we need to have a proper securitization law, for instance, because as it is right now, everything is all over the place, even in terms of the system, how SPV is created, how the ring fencing is done, who has the powers over all that. So it's all over the place. So unless now you see the same way we have a public debt or even just a test case, if anyone should just go to the public finance management, which is the overarching law in terms of the public finances, and inherently because these levies are part of the appropriation in aid. So typically they're also part of the PFM. There's nothing, if you search the word securitization, it will give you zero results. So that means that we need an overall law around securitization so that we can be able to have some clear safeguards in place in terms of how the securitization works. Secondly, also as far as the Auditor General is concerned, we also need this also the reports that is coming from this particular office, analyzing or auditing the national government funds. And a number of the national government funds, these are funds that have been created, such as for securitization, that's where they fall in place. But if you go to the website of Auditor General and say you want to look at Trailer Development Fund, the full report, you'll not find anything. It's quite high-level audit from the Auditor General. So perchance there is a parliament which receives this report. They need also to put the reports out. That will help the taxpayer to analyze what happened in any given fiscal year as far as the revenues that went into some of these funds that are now being used to securitize. So we need to have proper, at the first place, a mother securitization law that will be able to be the blueprint how securitization works in the country. And secondly, also in terms of the Auditor General reports, the post after any given fiscal year, as to be able to see how the proceeds were done. I think those two, when they are implemented, will be able to help any taxpayers to analyze the securitization. It's still pretty much new, but more needs to be done in terms of the legal framework around it.
I just want to pivot very slightly to something that was mentioned a little earlier on supplier debt, because I know this came up at the start of the hour. Because if you look at company numbers, we'll have debts or short-term, long-term credit in a separate part of accounts, and then we'll have trade receivables in a completely different section of those same accounts. And in some ways, it almost feels like government is treating it in the exact same way, because they will say, look, we know we owe suppliers X amount of cash, but these are not payments that have any interest accruing to them. It's not that we know of publicly. From a public accounting perspective, is that why we do not include supplier debt as part of our total debt stock? Bernard, do you want to weigh in on that?
I think the reason behind this is because the government is not willing to disclose all our financial obligations, because there is already a concern about the sustainability of our debt efforts. So government does not want to consolidate all these financial obligations, because such a disclosure will either sway investor perceptions or even expose the vulnerability of the country. When we talk about all the financial obligations, another interesting thing that the government keeps feeding is also the issue of pending bill. Like the amounts we owe to various suppliers, we don't include that. But from where I start, I think it would be a good practice for government to disclose everything that is owed to our suppliers, and also clearly disclose this issue of a securitized debt. Because Churchill said earlier, if you just scan through any report from the Office of the Controller of Budget or the Auditor General, you won't find a special report about securitized debt. And more will be securitized, but we don't know where this will fall under, or it's information that you can find in some of the reports that are coming from these constitutionally mandated oversight institutions. So having a special purpose vehicle is one thing, but now having a cabinet secretary and a board that is managing the fund, and they appear to have so much powers, also is another thing. And I think that will severely undermine the level of disclosure of public debt that we expect.
Stella, I want to come to you. There's something you put out on your Twitter timeline that made me actually pause and think about this in a bit more detail. You've argued that the current securitization strategy that we have, quote, prioritizes short-term relief over true debt sustainability, and it leaves the underlying debt trajectory unchecked. Tell us why, as taxpayers, we should be concerned.
I think that securitization leaves a lot of gray areas and does not necessarily prioritize debt sustainability, but just sorts the short-term liabilities or gives us some short-term relief if we're looking at our debt realistically. So why I say this and why a taxpayer should be concerned is because securitization technically commits future revenues. Same way, if we borrowed today money, we are committing future revenues. So I've always argued that securitization is more or less the same as debt, because the only difference between securitization and debt is that securitization is not considered as debt. That's the only difference. Everything else matches and qualifies securitization as debt. Number one, you're committing future revenues. Number two, you're sorting something now, especially the standard and the structure of how our securitization has been done for the road maintenance levy, especially that because we are borrowing some money, paying contractors, and then going back to the market, at least that's the plan, getting a bond, and then now paying that long-term loan using the revenues that will be collected from these particular funds or levies. So the reason I say that is because, as I've said, number one, you're creating some breathing room right now, but basically you're not reducing any obligations that the country has in terms of paying its debts in future. So that's number one. It only does that by improving the metrics right now, because this particular debt stock does not go into the overall trillions that we've already borrowed, but goes off balance sheet and then brings an illusion that we are borrowing less, but in reality, you're just borrowing as much, just that you're doing it off the books. So that's why I think that we are borrowing some room right now, and it's not necessarily as qualifying for debt sustainability. And why I said that, I was looking at the current affairs and current happenings, the programs that we've had, and what the government has been pursuing. So we've seen a lot of things in the debt space or in the fiscal space in the current environment. We've seen buybacks of Eurobonds, new issuances of these Eurobonds, and even some of them we are not seeing the logic behind, because we have bought back and refinanced Eurobonds that are less costly and replacing them with bonds or Eurobonds that are very costly. So when you look at the debt sustainability journey and what debt sustainability really means, that you don't see where these converge, because if you're looking at reducing our pressures and also reducing the amount of money that is going into debt servicing, then we should also look at the cost at which we are borrowing this debt. And the other thing that securitization does to our revenues is the same thing we are seeing now because of debts that we took earlier. So if we are committing our revenues, for example, from the road maintenance levy, then that means in future, in 2 years, 3 years, 5 years, we will still have the same problem of spending more than 50% of our revenues in servicing the debts that we have taken now. So technically, there is no difference between what we are calling securitization and what we would call conventional borrowing at this point in time. So yes, we are borrowing some breathing time right now, but it does not necessarily mean, and in essence, when you technically look at it, it does not reduce or align with debt sustainability.
I want to ask you a follow-up question on that, and then the others can weigh in as well. Because when you securitize, you're basically saying, yes, I'm borrowing, say, $1 million bob now on the assumption that I'm going to have steady revenues coming in over X period of time, right? So if you think about, say, for example, the road maintenance levy, we're saying that we'll borrow X amount of cash on the assumption that fuel consumption for petrol, diesel, whatever might remain steady. But here we are walking into a situation where, for the sake of argument, next fuel price adjustment cycle, let's say fuel prices go back to where they were in January 2024, $200 a liter, maybe more. Let's even raise that number higher, 250. Obviously, some sort of demand destruction happens at those levels. Revenues dip. And the thing that concerns me is that there's no clarity in the event that the underlying revenues fall below a certain threshold. What happens next? Are we in default? Are we deemed to be in default? Because that would imply that the debt we've borrowed in this securitization is essentially quote unquote debt, isn't it? Am I right to be concerned about the health of the underlying revenues that it seems, at least from the government's perspective, really isn't getting a lot of attention?
You were very right to be worried, and I would be worried as well of that, because those are questions that we have asked us. And I am thinking, if we are treating securitization not as debt, then us not being able to meet, for example, us saying that we're going to pay, let's say, 500 million every month, and we are not able to collect 500 million from the road maintenance levy, then we should not be considered to have defaulted. Because then if this is not being treated as debt, if we have not paid it, or if we fail to meet the obligation at a certain point, then I'm assuming the right way would go to restructuring and going back to the drawing board and saying, now, these are the amounts that we are collecting from the road maintenance levy at this particular time, or based on the specific environment and economic atmosphere that we are in. So how do we restructure this to enable us meet these obligations, either elongating the term of which we are paying this debt, or I don't know whether this money should be gotten from any other fund or from any other source within the consolidated fund. But I think these are the things that are missing from the structure and also the disclosures of how this securitization is being done. Because then the problem arises because we are looking at things from an after-fact perspective and not necessarily before they happen. So then we seem very helpless as the analysts as well as the taxpayers, because then we do not know what is the structure of this thing that we are looking at. What if it fails? What if we are able to meet the obligations faster? For example, if the demand for fuel goes up and we are collecting more in the road maintenance levy fund. So what happens when all of these scenarios and all of these checks come in? So I think these are the things that are missing, and some of the things that the National Treasury and also the Parliament, so to say, should be pushing towards, so that we have a structure and a way that we know if this is not happening, then this will happen. If this has not happened, then this is the right way to go, or this is the way that we plan to go.
Churchill, I want to build on Stella's response there, because the counter argument that we often hear from government is this securitization allows us to raise money to build infrastructure without necessarily raising more debt. But correct me if I'm mistaken, I remember this question of securitization qualifying as debt coming up in talks between Kenya and the IMF on a new program. And there was a lot of disagreement around that, wasn't there?
Yeah, for sure. There are disagreements in terms of treatment of securitization. I think if you take a step back and put yourself in the authority's shoes, I think probably they're just looking at public debt as anything that is being serviced from consolidated fund. And here we are, we have these levies that goes into this sports betting, railway development fund, anything that is securitized. So those will be funded from levies, which levies are what you call appropriation in aid. So anything that goes into appropriation in aid does not end up in the consolidated fund. So probably that's the argument that the authorities are coming from. That, okay, I mean, it's interest, public debt, obligations coming from consolidated fund, but here it's something that is off consolidated fund. I think probably that's where they're coming from. But ultimately, as Stella has tried to argue the case that it's debt, securitization is debt, that there was a way that she phrased it, which was quite nicely. But it's just that it's not considered debt, but it's debt in the sense that there's an underlying debt instrument. In this case, there's a corporate bond that ultimately will be issued and will be listed in the Nairobi Securities Exchange, because ultimately it has to come to the market. But now the servicing of this will not necessarily come from the consolidated fund, but now these receivables that are being ring-fenced. But ultimately, it's debt. So the argument probably is that, is it central government debt per se, or is it like ministries, department debt, not part of the central government, just understanding of central government is national government debt? Or is it like one of the state agencies, or SPV, that is issuing the debt? But ultimately, and in the case of Ghana, whereby they also had debts, securitization debts, Dache bond. Dache was of education. There was a levy that every taxpayer in Ghana used to pay towards the education sector. And based on that, Dache bonds came to be. And also there's another ESLA, Energy Sector Levy Act bond. So ESLA bonds also came to be, being securitized of some levies to the energy sector. And we all know how when the default event happened, evidently people were focusing on the central government debt in Ghana. But ultimately, even these two securitization bonds had to be restructured. So in terms of risk management, I think that's the issue. In terms of risk management, IMF is looking at it. Okay, wait a minute. If there's a default event that happens, you will have now to restructure all the debt, even if you don't look at it from a central government debt perspective. You may reclassify it as corporate bond or anything else, securitization. But ultimately, if the default event, like in the case of Ghana, you will just have also to look at also this securitization debt. So I think that's pretty much the argument that the IMF is trying to put across. Whereas I think from the government perspective, they're just thinking, okay, debt in our view is consolidated funds. So I think that's where the point of departure is between the authorities and also the IMF in treatment of securitization.
But now I want to come to you with a question around ring fencing or proceeds and also the underlying revenues by extent. An example I'm going to give is from IFBs, infrastructure bonds. Those of us who do invest in bonds every now and then, we love the returns on these. They're fantastic instruments in some respects. But when you look at the prospectus for an IFB, at least the ones that have been issued over the last couple of years, 5-6 years, it very rarely ever says exactly where the proceeds are going to be used. Is this going into a road? Is this going to fund water? Is this going into energy? It's not actually stated. And once the funds are in there, in the government's hands, they get commingled with other revenue. Given the fact that we're trying to essentially enhance debt transparency, isn't this lack of disclosure and the lack of seriousness around ring fencing proceeds and underlying revenues, doesn't that undermine these whole commitments that we hear from the finance ministry of, yeah, we're going to be transparent about how we spend public money?
Before I come to that, I want to add to the issue of securitization. Churchill talked about the issue of consolidated funds. So where is this money going to? So if it's coming from the consolidated fund, then that qualifies this issue of securitization as a debt. If the borrowing was having a collateral that is collateralized, then in case of default, I think the creditor can try to effect through litigation to recoup the money. But are we having this kind of information disclosed to us as Kenyans by the government? So I think there is some opaqueness around that, whether there is any asset, any national asset that has been used as a collateral. Do we have a guarantor? Do we have reserve funds set for this kind of securitized debt? And if so, what is the implication, the fiscal implication for that country? I come back now to the issue of the infrastructure board. Unfortunately, every time the government is going to the market to borrow, there is no single project that is earmarked that once we get this money, we will ensure that the proceeds will finance this kind of a project, or a project that you can point and even monitor its completion rate, whether it's a stalled project, whether it's a high impact project. It's a problem and a real one. And the other thing, when we talk about the lack of failure to ring-fence funds, if you happen to ask for this kind of information from the National Treasury, the response you will get is that we used the borrowing for budgetary support. So that's a very broad and opaque statement, that the money was used for budgetary support. Yet we know money borrowed should be used for development expenditure. So when we allow the government to use the term budgetary support, then that's where the system fails to account effectively and fully for any borrowed monies, because budgetary support also includes recurrent expenditure. And that has been happening in Kenya of late. Actually, the last couple of financial years, it has been happening, going to the market to borrow. Yes, you issue infrastructure bonds, but the money ends up being used to finance recurrent expenditure. Eventually, what happens now when the citizens find the whole system opaque, that they cannot access information meaningful to hold those into account, that now resorts to the litigation route. But the litigation route should come as a last option, because we have systems, we have institutions in place. By the time either a private citizen or an entity moves to court to compel the government to be transparent, it's an indication that the system in itself is not working, because that issue of transparency should not come through court battles, but it should be systematic in our institutions and our practice. So the fact that citizens have to go through the courts to access debt agreements, it signals that something is fundamentally wrong, even with our oversight institutions. For example, Parliament. Why should the citizen be pursuing litigation when we have a debt and privatization committee within the National Assembly? It should come as a watchdog for the executive. But when that happens now, it simply shows how the citizens have been left alone, yet they are the ones bearing the burden of these debts. What needs now to be stronger to avoid these litigation processes is like having stronger ex-ante transparency requirements, where there is full publication of loan terms, the guarantees, the securitization arrangements, and how those processes are backed by Parliament and the audit institutions that we have in place.
There's a couple of interesting questions that are being raised in the DMs. And this goes back to the 2008 financial crisis, when we had an enormous amount of securitization that was taking place across the board, right? Those of us old enough will remember hearing about mortgage-backed securities, which apparently were rated AAA, when the underlying revenues, the people were servicing these mortgages, and they simply couldn't anymore. That entire house of cards came tumbling down. And the question is this: in our context here in Kenya, isn't that use of securitization reintroducing similar opacity, especially around contingent liabilities, true risk transfer, and actually the quality of the underlying cash flows? Churchill, Stella, do you want to take this?
I see the validity of the question. And yeah, the risks are there of replicating such a scenario, because then if you look at the two cases, you see the issue of using debt or issuing debt off balance sheet, replicating in both cases. However, I do not think that it goes to that extent, given the amount of money that we are looking at here, because there are other cash flows coming in between. But then the risk here for me is that if this continues and we continue to securitize more funds, and even within the same levies and funds, securitizing more of the revenues being collected, then it becomes a cyclical issue. So why I say this is because when we were looking at the present securitization, there are still plans of securitizing more from, for example, the road maintenance levy. I don't know where the Treasury has reached with that, but then if you're securitizing more and more, then it means you're collecting less for the other needs that you have as a country. And then this means that you will borrow from other sources and innovate with other forms of debt collection and debt mobilization so that you're able to meet the day-to-day operations of the government and also of the country. So yes, I think that is a risk, but not necessary to that extent, because the amount vary, because this one was a way of higher amounts and of higher intensity as compared to what we are looking at now. So the major risk would be more securitization of funds from this particular levy or other segments where we collect revenues as a country.
Churchill, you were two cents.
I think probably we need to distinguish the different types of securitizations that we have. Probably let me bring out two. So we have, the first one is a sale securitization. So whereby there is the sale of assets to an SPV. So the transfer of risk is now to the investors. So this is the case that Kenya is pursuing, whereby we have the securitization format SPV being created, and then out of that, the SPV will now have a half charge on the receivables, on the underlying revenue. And then for the second one is like a synthetic securitization. It's taking us back to the 2008 crisis, whereby it was essentially credit risk being transferred to investors, but without the underlying assets. So the banks will now create all this man of mortgage-backed securities and a whole host of all these things that were created in the run-up to the 2008 financial crisis. But now the investors did not have underlying claim on the different assets. So it freed banks, removing the credit risk to investors and then having some capability to now be able to lend more. That's different from what we have right now. So the risk that it might lead to a blow-up of a financial crisis probably may not accrue similarly, because in any case, these guys, there's an SPV that is involved, and the SPV is the one that is creating a whole debt. So we haven't seen the kind of financial engineering to the large extent that we saw in 2008 with these formats that Kenya is pursuing. Probably in the future, you never know the creativity of the current authorities. So probably we might see some synthetic securitization being created, and that's where probably there could be a bigger risk. But as it is right now, the format of securitization that is being pursued probably is not as riskier as what you saw in 2008.
Bernard, I want to come back to something that you mentioned a little earlier, because as I mentioned at the very start of the hour, there have been multiple fights in Kenya over debt transparency, including the debt agreements between Kenya and the Exim Bank of China, for example, to build the first half of the SGR from Mombasa all the way to Nairobi, and then the 120-kilometer extension to Suswa. Do you see a situation where we're going to have a lot more taxpayers going to court and challenging the authorities over and over again on debt transparency, simply because so far there hasn't been enough disclosure on what our obligations are?
I think from this conversation, the experiences we are having current with the reform of debt disclosure, it's likely that taxpayers will move to courts seeking information, because government will not willingly or voluntarily give you this kind of information, especially. But the thing that has been happening is government hiding behind the non-disclosure clauses. And that's what the government has been saying every time even Parliament asked for the SGR contract. The word is, there is a non-disclosure clause.
That argument always a really false one, because when they keep coming back to that whole, we can't disclose because whoever we're borrowing from put these clauses into the contract. A, doesn't that speak to a lack of legal competence on our side? And B, isn't that illegal in the sense that the Kenyan state has an obligation to tell taxpayers, I have borrowed money from XYZ, these are the terms. They have a legal obligation to be honest with us. So in that sense, aren't those non-disclosure clauses in effect in contravention of the Kenyan constitution?
It's a good question, because once you hear those kind of arguments, you wonder whether at the time these contracts are signed, whether they go through the Attorney General's office or it goes through the Attorney General's office, but because of the competing interests within the executive, there is a deliberate assumption of some of these risks, especially when there are non-disclosure clauses. The other gap that could be there is within our PFM Act, because once Parliament approves the medium-term debt strategy and the annual borrowing plan, the Cabinet Secretary for National Treasury and Economic Planning is at liberty to go and contract debt. The only requirement is for the National Treasury to report back to at least 3 months after debt has been contracted. So even if we have quarterly reports, that safeguard cannot really correct the mess that has already happened. Like Churchill said earlier, I think there is a need also to look into our PFM Act, and where there are excessive power given to the CS, then there should be a requirement that Parliament ratifies some of the debt contracts, especially the ones that are so huge and they pose the greatest risks to the Republic of Kenya. I think it's a mix of issues. Parliament failing to oversight, then conflicting interests within the executive that results in the Attorney General not flagging some of these gaps. And these are the issues that will lead taxpayers to go through the litigation route, because government will not just disclose this information by walking into either of their offices, because someone is fearing to be held accountable somewhere. So I think we are likely to see more of this coming.
And there's an interesting article to your point. There's a really interesting article in the Daily Nation today where the Auditor General is actually coming out with a report that points out that the National Treasury evaded parliamentary approval in securitizing the proceeds from the road maintenance levy fund in order to cover 175 billion shillings that was advanced to government to settle pending bills in the State Department for Road. It's going back to all the things we've discussed over the course of the hour, that lack of transparency, that tendency to ignore appropriate procedure as well. I want to pose a pullback and just ask a broader question to the three of you, starting with you, Churchill. At various points in time, and this was a big thing in 2024, came up again in 2025, we've seen repeated calls for an audit of the stock of public debts that Kenya has. To remind our listeners, we owe at this point in time over 12 trillion Kenyan shillings. That's about $1,800 for every single person in the Republic. An 8-person team was set up to probe the matter back in 2024. But with the benefit of hindsight, is there an argument for auditing all public debt or just portions of it?
So let me, in answering that, also I'll be referencing to the terms of the scope of that particular committee in terms of the audit. But I think ultimately, whenever there's a call or whenever there are calls of auditing Kenya's public debt or people rushing to court, largely it boils down to some of the debt that have been contracted by the government, which are seen as outside the scope of borrowing. For instance, in the current financial year, I think we should be borrowing 1 trillion Kenya shillings, thereabout. 1 trillion Kenya shillings in the current financial year, 1.1 trillion after the revision of the supplementary budget. But this 1.1 trillion, this is net borrowing. And by net borrowing, I mean it excludes what you call the debts that are being redeemed or amortized debts. But in actual sense, you'll be borrowing more than the 1.1 trillion. So you have to borrow another additional 800 billion more so as to be able to repay the debts that are maturing. And so in actual sense, the actual borrowing is around 1.9 trillion or 2 trillion, thereabout. So it's easier for somebody to rush to court that, hey, wait a minute, you said in the budget policy statement, all these budget documents that you're borrowing 1.1 trillion. But how can you borrow 2 trillion? It's just that there's an ambiguity in the law that they really need to point out. It's just that I forget the exact section of the PFM, that we are borrowing in net terms, whatever is in the budget. So it's clear to everyone that this is in net terms borrowing as opposed to the gross borrowing. I think that's one. Another ambiguity in the law is also in regards to Section 15 of the PFM Act, and that the fiscal responsibility under the Kenyan law. So that speaks to the borrowing levels. The borrowing should be for development. The borrowing should be largely for development and not for recurrence, largely. So we find that it speaks largely Section 15 to say, over the medium term, the national government's borrowings shall be used only for the purpose of financing development expenditure and not for recurrent expenditure. So let me just draw your attention, and I think I've been banging the table wherever I am given an opportunity to discuss these points. Over the medium term, at the point whereby you are putting a budget for the next financial year, which will be fiscal year 26-27, over the medium term, it's a 3-year period. So it ends pretty much at fiscal year 2029-2030, thereabouts. So it's a moving target, this over the medium term. So I wish that we could revisit this Section 15 and probably say that by, say, fiscal year 2028 or by June 2028, all the borrowing should be for development and not recurrent. We just have a hard coding on the sunset date that we need to see implementation of this so that we remove all these ambiguities, because this tends to be a moving target. Any given fiscal year has its own over the medium term, if I may put it that way. So we just need to clear doubts and we know where we are moving forward. And then that now fits in that, okay, if borrowing is for development, these are the specific development projects that needs to be funded from borrowing. There's a question that also you asked around infrastructure funding. And that's also another thing, is for budget support. Initially, we could see prospectus for infrastructure bonds, speaking about funding water, energy, and I think roads. But right now, it's as blanket as it can be. So we never get an understanding of where the borrowing is. So I think when you talk about the public audit, I think it also touches around these issues. The other bit, I think, is also on the cost, the value of money for some of the borrowing, but I think debatable, and also comes across some of the borrowing. Commercial borrowing, this is domestically, treasury bonds, treasury bills, this we borrow on commercial terms. And yet on the other side, we need to get a return on investment. So if you're borrowing, say, for instance, we borrowed an infrastructure bond, the government issued an infrastructure bond at a cost of 18%. So what is the investment that will now be able to justify borrowing at 18%, for instance? So those are the things that I think probably the audit will have highlighted more and more, some of the qualifying issues or the public debt. But I think broadly, the issues that I've highlighted around the ambiguities in the law are the ones that leads to calls for audits of the public debt.
As I mentioned earlier, these conversations are not just among the three of us in Kenya Perspective. I want to bring in Jaffa Justine. He was the former managing director for the Tanzania Agricultural Development Bank. He's an investment banker. He's been very patiently listening to the conversation we've been having here for the last hour. Justine, welcome to the program. You've been listening quite patiently for the last 45 minutes plus. Give us your initial thoughts.
Thanks, Rob. I appreciate it for the bio at a high level. I enjoyed the conversation and wanted to add my few cents, especially on a few areas on the back of my experience dealing with public debt. I might give you some few context, especially market like Tanzania. You'll be interested to understand or to know that the issue of transparency is very broad, but very critical on the back of managing public debt, but also goes even much deeper on disclosure of all these activities which are happening within the space of fiscal. You take note, like a country like Tanzania, we publish, and that was on the back of the parliament asking the government to start publishing the public debt financials specific for public debt. And we started in year 2024, and this will be our third year consecutive, publishing the balance sheet, P&L, and all related financial statements for public debt for Tanzania. And we do that because it's on the back of the Public Finance Act, which directed that we should be preparing the debt or the report for the Controller and the Auditor General on the financial and the compliance audit for financials. And we do this year in, year out. This is being done by the Controller and the Auditor General, and it's part of the transparency, which has given us even more visibility. This is the third year. You'll be able to get this report on the Ministry of Finance website. And in terms of credibility, we have seen publishing might not sound easy, especially for people on the fiscals, but it's very critical, especially on when you want to approach markets and grow your credibility in the market. I believe a review of the Kenya Public Finance Act will be critical, but you'll be interested, I think, which is interesting for Tanzania. The government loans, guarantees and the Grants Act is of 1977. So this legislation gives us a bit of clarity on how to manage front office activities, middle office activities, and the back office activities. And then you do your quarterly reports, and this has really played a very critical role. But also on the back of this, which I shared with the team in Kenya sometimes last year, when they visited us for a detailed technical discussion and knowledge sharing, was also on the back of having a robust system. I remember 4 years back, 3 years back, the system which was used to keep the data database was just a statistical Excel system. But we had to move to a level where you've got an accrual-based system, which is the state of the art. Literally, it's, I would say, not a mini core banking system, but that's the level of transparency now we are able even to publish the financials. And at any particular time, you'll be interested to see the debt stock, which loans have been approved the past few weeks, And I think a good clarity will also be able to see on the South African Minister of Finance website. They publish every loan they sign. Like West Tanzania, we publish. South Africa goes a step further and even give you the terms and the conditions. But this is for clarity because you look at all these countries of ours, public debt servicing is costing quite substantial amount, more than, I would say, for Tanzania, it's around 35% of the entire budget goes to debt service. And other countries, you're sitting more than 50-70%. So you need to create accountability, which I believe through the review of the legislation will be very critical. And I don't see what's the reason why most of us, because we want to go to market and you don't have quite credible information. That's one for me. I think, again, a bigger conversation on public debt, especially transparency and all aspects, is also choice of instruments. Not every instrument fit for general budget support, and not every instrument fit for project financing. It's a whole different conversation, and they need a detailed understanding. For me, there is a very thin line between public debt management and investment banking. You're literally learning an investment banking within a public setting, and you need the acumen, you need the knowledge, a typical experience on how really to structure these instruments. You could do an easy securitization, but I would really be happy if you do a securitization for a specific project from a ring-fenced source. That will be a different conversation. You can do securitization for general budget support. That will create even, I would say, an imminent problem. So all these instruments, we're seeing a lot of development in the market. Not every instrument just goes in as 1+1. All these instruments need a thorough technical review and understanding, at least to give you space to be able to accommodate within your medium-term debt strategy, but also on the back of the debt sustainability analysis you're doing every now and then. You need data transparency, but that will be informed by a robust core banking system, and eventually you'll need to work around your legal framework. Legal framework will remain critical. Lumping public debt within public finance, I feel like you're not shielding enough your debt management in terms of transparency. So this is a bigger conversation. Our audit, and we have seen 3 years now, and consistently we've been able to publish. And the public reviews, all instruments we've signed and all outstanding debts and all numbers are within in there for public to consume, but also to make use of the information. By a few cents, might not be as straight as you wish, but I would say that's my little experience.
No, it certainly helps. But I want to draw on your experience in the public sector as well. Based on something that you mentioned a little earlier, you said that it might be a bit difficult for people on the fiscal side, on the government side, to be transparent. And I'm trying to see what you can tell us about this without breaching confidentiality rules. But what is it about the culture in government, generally speaking, that makes them averse to transparency? Because eventually you need public buy-in when you're saying, look, I'm spending a third of our tax revenues on servicing our debts. This is where that money has gone. This is why we went with financing from this source rather than that other source. Because when you're asking people to pay more in taxes, or they're having to make certain sacrifices in spending cuts, they're obviously going to ask why. And I think from the outside, a lot of us would agree that being transparent is the rational thing to do. It won't always be comfortable, but it is the rational thing to do. And yet in public service, that's not always the case. Why?
Look, it differ context, country specifics, but I think for us, we've had good breakthrough in managing public debt and putting public information, being able to use the legislation which has been in place since 1977. It's still doable. It's not as tough as it sounds, I would say, because if you, first of all, build on your system, I think that's critical and key. Most of the sovereign, the biggest struggle is also tracking the debt. People are still using Excel sheets. People are still using statistical systems, which are literally not supportive enough to give you real-time information. Like ours, we have integrated with the central bank system. We have integrated with payment system. We have integrated with Swift systems. I have all the 360 degrees now in every transaction I do. If I pay in a bank, I'm able to pull that. That's one. So if you don't reach this level of clarity in terms of your data, no wonder when we discuss in debt, we discuss mostly of unified debt management. That means you need to have a solid debt database team, which will spend time morning, evening, telling you clarity on each particular loan, each particular repayment schedule, each particular interest instrument which has been deployed. Every auction, when it's completed for us, it's real time updated in the core banking system, so in the debt system. But you'll find, and this is what we've been seeing, we're receiving a couple of countries come to lend, and you see there's a gap if you don't have a solid system which will really help you to get this real time information. And you find yourself, instead of going into the full transparency, eventually, because you've got a lot of issues to fix on the back, you eventually go a bit slow. But for me, that comes with a huge cost. Because public today is very rich on information. People want to know, where did this fund go? Why did we commit this much? Why are you even publishing a medium-term strategy in choosing which kind of instrument you'll be using in funding the budget? And I keep saying, you can't use Eurobond to do your general budget support because that's a bullet one. And one of the colleagues was talking here, whatever you put in the consolidated fund is normally, we say, it's become fungible. You can't trace whatever goes to consolidated. So you need to know if you're going to go for general budget support, you need to be clear on which instrument you're going to use. For us, if we do a 5 years project, 7 years project, literally I cannot do a Eurobond because I don't need the bullet in year one. I will be able to ascertain the cash flows on the back of the year. So I will structure my financing either through ECA instrument or any other instrument which does not give me the lump sum today, which normally create a bit of appetite to use for other activities. So transparency is still doable. I think these are the conversations we need to elevate, but it's on the back of a proper middle office, proper back office, and a proper front office. And all of these have to speak on the back of the unified debt management. The disintegration of this, because in other countries you find debt database sitting with accountant general's office, and then you find the debt management office only does the risk assessment. And then you find there's external financing also sitting on your mobilizing resources. When you find all these three not talking together, you have a crisis. And the only way to narrow down on this, you need to have a unified and then have a conversation as well as strategy. The less of that, you will struggle with transparency. Transparency is very broad, and that's where it covers a lot, which for me might be a cover of efficiency or inefficiency at some point.
Indeed. And of course, conversations like these wouldn't happen if we didn't have the support of institutions like IPF, the Institute of Public Finance. One last question for you, Justine, just before we move into the closing segment. I believe Tanzania has a Treasury single account system in place, doesn't it?
Indeed, we do.
And that helps in giving you the visibility, the 360 visibility you're talking about a little earlier, because you can see what's coming in and what's going out.
Spot on. I think that's the level. So we have multiple systems, and happy now we have really delivered on integration of all these systems. Got Treasury single account. We've got a system which manage all the government payments, which is called the MOSE. And you have got a public debt system, which is state-of-the-art called Meridian, which Kenya is working to deploy. You have got another system which feed into the Meridian audit system, which is the one which manages the government auctions processes. So all these systems are speaking to each other. The integration is very critical and very key. You need to build that, at least for seamless flow of your opening balances in the morning and also the closing balances, which will help you to manage your cash flows. But essentially, still, I would say, the more has to be done on the revenue side. I'm a fan of FDIs more and less of putting more of additional taxes, which in the end you might find having a lot of nuances or a lot of levies. FDIs, you look at the Asian countries, they've done quite well in balancing between debt and FDIs flow, which has really built up their revenue bases, and that has propelled the growth. The only way to fix your debt crisis, for me, you really need to address the business environment to the revenue lines and essentially the exports line, which really take you to the level where Japan is, where US is, still at 100, but still they've got enough liquidity to service the debts.
Indeed. And just for our listeners, for a bit of interesting comparison between the public finance situation in Tanzania and the public finance situation in Kenya, to Justine's point a little earlier, Tanzania is spending about debt service in total. This is both interest and principal is taking up about a third of government revenues. In Kenya, interest service is taking up a third of tax revenues. And we're, I think, somewhere in the top 6 countries by that metric, according to Moody's data. Churchill, I want to come to you for one question before we get into the closing bit. Do we end up paying a premium when you come to markets because of this lack of proper transparency on how much debts do we actually have? What terms did we borrow it on? Is there a penalty, a price penalty that we can point to and say, because of this lack of transparency, Kenya ends up borrowing Eurobonds, for example, at 9.75%, when peer countries are borrowing at 7.5% or 6.5%.
Explicitly, I doubt that is the case. I think even the way investors, in this case, the commercial debt component, this now the external commercial debt, and this is Eurobonds, the way they look at it is they do different comparative analysis, just looking at the ratings, where it is, looking at even the engagements with the authorities. So debt transparency, as far as foreign investor who is investing in Eurobonds, because they can see the transparency of Eurobonds, that's pretty much what they care. So it's readily available, Reuters, Bloomberg, or all these other sources. So as far as they are concerned, where their interest is, and this is Eurobonds, it's pretty much easy just to see the transparency, because all the information is available through the different platforms that are out there. So explicitly, not really, but implicitly, because data transparency speaks about issues around even fiscal indiscipline in one way or another. If the source of you've borrowed the money and then you are supposed to invest in different sectors, but evidently the government is not able to generate enough revenue even to service the funds, it's visible even in terms of even the debt servicing as components, looking at even some of the fiscal deficit pile up further down the line. So implicitly, yes, you can see that issues arising from a lack of transparency has a ripple effect in an implicit manner. So those evidently they keep an eye on. Explicitly, probably they may not even care of the transparency because their interest is on the Eurobonds. Unless now it's a case of tuna bonds where, hey, wait a minute, the government has been borrowing some private loans and this have not even been put in the public debt view. On the case of Senegal, that is still ongoing. So that's what spooks the investors, but it may not even come out at the point of Eurobond issuance that transparency is quite key. But evidently, as these things blow up, some hidden debt or some myth debt somewhere. So those are the things that spooks investors.
Bernard, you get to close that out in this conversation. From the perspective of public finance, what are the main policy changes you'd like us to do this year? Let's assume for the sake of argument, we can put this into a policy paper and send it over to Treasury, send it over to the Budget Committee, send it to the Finance Committee. What should we put in there? What are the main policy changes we need to make progress in making proper transparency a reality on public debt?
I will talk about what we can achieve within the next financial year, that is 26-27. One, government can avoid being reactive and have transparency embedded in every process of our budget and also in every process in our borrowing. And by that, we should have full spectrum transparency instead of what we are having currently, what I would refer as partial disclosure. Then the National Treasury can deliberately, and when there is a goodwill, make a publication of loan agreement mandatory, including fees, the terms and conditions, and the collateral clauses. That does not require any amendment to the Public Finance Management Act or even to the Constitution. It's something that requires a goodwill from the government. But another policy that the government can adopt to improve on transparency is through comprehensive debt registers that includes even securitized obligations. The other thing that we can have right away is having a fiscal framework where the revenue side and the expenditure side speak to each other. The disconnect we are having right now is just a signal of the fiscal indiscipline that the government is pursuing intentionally. But what we can, again, achieve in the long run or in the medium term, and that can help us in making sure that fiscal discipline is exercised in this country and that there is debt transparency, is having a national treasury that is independent. And we should have that entity called the National Treasury come with independence, headed by a technocrat, not a politician who has changed the electoral cycle, or every time there is a change in the regime, there should be a person who has a security of tenure and who is not controlled by the executive. I think that in the medium term or the long run can help this country to have the kind of independent analysis, the kind of fiscal discipline, and the level of disclosure that we would like to see when it comes to the borrowing practices in this country. Thank you.
Thank you very much. And I want to say a massive thank you to all the panelists and our speakers today. Bernard G, of course, Senior Research Analyst and covering macro, fiscal, and debt analysis at the Institute of Public Finance, okay, an economic analyst, and Treasury Go-to economist at IC Group. And of course, on top of all of that, our brother from right across the border in Tanzania, Jeffrey Justine Desana, for sharing your experience and your perspective on what Tanzania has gotten, because what this demonstrates and what this reminds us all is that we're not talking about esoteric things. We're not trying to build a rocket that'll get us all the way to Europa, one of the moons around Jupiter. These are solutions that we can implement quite seriously, quite feasibly in our countries across the region as well. Asanteni Sana for your time, and we will see you certainly in future editions of Spaces here at Mango Capital. Thank you very much.